First of all, let's take a step back with a lot of these sponsors. When you go back to the history of the economy and the cyclicality and what's happened, a lot of these guys that are currently successful and some of the ones that are in trouble, you go back to 2000, 6, 7, 8, 9, 10. At best, they were in college. Maybe they were in high school. So they don't necessarily approach with any significant degree of caution. It's like it's all right. Let's see how much we could ramp up the model. Let's see how we can be creative. And we look at it as, how do you put food on your table? What if you're a W-2 employee and you get laid off? You'd like to have cash flow. You're not betting it on IRR. It's like, Jeff and I once went to a meeting with Cerberus Capital, and we asked the guy who worked in the real estate group, tell me, what does Cerberus do? He goes, well, we buy companies, we do some bridge lending, we do some real estate, but we also do a lot of binary investments. And we're all looking at each other like, what's a binary investment? And the fellow says to us, well, it's either we win or we get a bag of bagels. They get nothing. So, I think of IRR is great. And in an upswing market, like we've seen, 2010, 11, 12, 15, 18, everybody won. But nobody ever thought you'd reach the peak and it would all work against you.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show at youtube.com/GowerCrowd. Thanks so much for joining me today. My guest today is Irwin Boris. Irwin is heads up investor relations and acquisitions at Heritage Capital Group. They are a third generation family office. They handle over 750 million of assets and of AUM, with a focus these days on industrial real estate, but they have quite a storied history, as you can imagine, over 3 generations. You're going to hear all about it from Irwin today. Irwin has they have a really nuanced approach to commercial real estate investing that shines particularly today when the markets are in the turmoil that they are. And, the fix and flippers, and I say fix and flip, I mean the fix and flippers that bought $100 million fix and flippers are all stumbling and falling because of, I guess, imprudent underwriting and not taking a longer term perspective. Folk like Irwin Boris and Jeff Greenberg over there, who's the head of family at Heritage Capital Group, really shine. So you're going to learn a lot from them, from Irwin today. He does reference Jeff a few times, so I figure I should introduce him in this introduction. If you want to know more about Irwin and Heritage Capital Group, go to the podcast page at GowerCrowd.com. I'll put a bunch of links there to him and the company. And while you're there, of course, subscribe to our newsletter. It goes out every Wednesday. It's totally free, and you can always unsubscribe. Give it a whirl. All right, that's it. Irwin Boris, head of investor relations and acquisitions, Heritage Capital Group, coming right up. Irwin, it's good to see you, as always.
Good to see you too, Adam.
I'm going to open up with the number one question. You can't eat the IRR. And that's your ultimate expression over there. Talk to me about, what do you mean you can't eat the IRR? What does that mean from the kind of the perspective of Heritage Capital Group?
Let's put it in terms of cooking or baking. There's a lot of ingredients that goes into getting to the IRR. And it could take 3, 5, 7 years, maybe longer, to achieve a pro forma IRR or the completed recipe. But in the meantime, there are things you're going to want to do. There's food you need to put on the table. There's luxuries you might want to buy yourself along the way. And, you're dependent upon a lot of ingredients going into that cake, and none of them being spoiled, or the right amount of water, the right amount of yeast. And, as we've all been told as kids, don't jump when your mother's baking because the cake will fall. And so IRR is great, but I think it's more of a question of a focus on putting men on bases and scoring runs and looking for, grand slam home runs.
Okay, so there's lots of analogies there,
Yes.
specifically related to real estate. One of the reasons that this came up when you and I have been chatting over the last few months is that what we've been seeing is a lot of new to the industry sponsors advertising these incredibly high IRRs and ending up with variable rate loans and having difficulties with that. So it's in that context, right, isn't it?
Correct. No,
Investors.
it's in that context. I think, first of all, I think let's take a step back with a lot of these sponsors. When you go back to the history of the economy and the cyclicality and what's happened, a lot of these guys that are currently, successful and some of the ones that are in trouble, you go back to 2000, 6, 7, 8, 9, 10, at best they were in college. Maybe they were in high school. So they don't necessarily approach with any significant degree of caution. It's like it's all right. Let's see how much we could ramp up the model. Let's see how we can be creative. And we look at it as, how do you put food on your table? What if you're a W-2 employee and you get laid off? You'd like to have cash flow. You're not betting it on IRR. It's like, we once went for Jeff and I once went to a meeting with Cerberus Capital, and we asked the guy who worked in the real estate group, tell me, what does Cerberus do? He goes, well, we buy companies, we do some bridge lending, we do some real estate, but we also do a lot of binary investments. And we're all looking at each other like, what's a binary investment? And the fellow says to us, well, it's either we win or we get a bag of bagels. They get nothing. So, I think of IRR is great. And in an upswing market, like we've seen, 2010, 11, 12, 15, 18, everybody won. But nobody ever thought you'd reach the peak and it would all work against you.
Right. So what's important about that is caution, and what comes from caution is experience. Caution comes from experience. So why don't you tell me a little about tell the viewers here a little about heritage and from your point of view, the lens through which you see the world.
Sure. We look at each investment as if we're going to own it forever. And so the most important thing to us is, does the asset have the legs to pay continuous cash flow? Because if your rent is there and contractual rents grow at, take your body weight. You take your body weight and compound it 3% a year for 5, 7, or 10 years, you're going to gain a lot of weight. So if we believe the asset is in the right location, has the right mix of tenancy, and can appeal to others, it'll always stay full. And so if we're going to get that rent and the cash flow is going to continually increase, then there's going to be an IRR at the end of the day. Whether we choose to sell or our partners say, no, we want to hold it for the cash flow, that's another story. But I think it's safer for a prospective investor to look at what's the current return. And I had that conversation with two gentlemen this morning. They said, you know what, we're in these deals, and they talked about a 9% preferred return and an IRR and a multiple. He goes, but I didn't think we were only going to get 4% a year, and some of them stopped paying. And I explained to them, how we do things. And, how we do it isn't perfect for everybody. We're not looking for people that, want to, hit it out of the park. We're looking for people that want cash flow.
But hang on a minute. Heritage, let's step back a little bit further.
Sure.
Tell me about Heritage. Third generation family office.
Yeah, Heritage
what
is
kind
a
of asset classes, what kind of scale? Let's get into the details.
Heritage is a third generation real estate family office. It was founded by Jeff's grandfather, who was a pharmacist, and realized there was more money in owning the building than there was in operating the pharmacy. And so they raised money to buy the building and then continued to buy other buildings. And from these other buildings, they started, mixed use, and then to garden apartments, where at one point there were, I think, over 7,000 garden apartments. And they looked at it from a cash flow basis, because, cash flow is how families distribute money. That's how they make philanthropic donations. They don't spend principal. So the cash flow is of extreme importance. No one wants to suffer a loss. No one wants to spend the capital. So it's about the cash flow. And over the years, although it started off as all family money, and then it was cousins, and then it was country club, and then it was outside friends, and every friend brings another friend, and until we actually got approached by some institutional partners, we like what you're doing. We like your conservative nature. And so, we have institutional partners. We have, syndications that involve maybe 6 or 8 high net worth people that are writing larger checks, and smaller checks. But it's because of our conservative nature and the way we approach these deals that people keep calling us.
And your portfolio assets under management about 750 million.
Yes, correct.
Yeah.
About 750, and some of those include some they include some multifamily, some office investments, some institutional quality office, some hotel investments, some land that's being zoned and redeveloped for future development in underserved locations, and also a lot of industrial.
Right. Mostly industrial, isn't it?
That's correct.
What is it you guys like about industrial?
When you think about it, we were investing in industrial, 15, 20 years ago when everybody thought it was the ugliest thing and dirty and nobody wanted it and you could buy it on extremely high cap rates. It's only more recently that, with people like Blackstone and Starwood and others, that it became sort of a little more attractive. But, industrial needs to be there. You think of our economy and the amount of stuff, goods and services and goods that have to come in and have to get warehoused and have to get distributed. Some manufacturing is done here. Concrete plants, electrical, conduit. Not everything is imported. There's still a lot of manufacturing that comes, down in the United States. You think about Coca-Cola, Pepsi, Frito-Lay, they're not bagging those chips in Mexico or South America or China. That stuff's getting manufactured here. The raw material's coming in. It's got to be stored somewhere. It's got to be labeled, manufactured, shipped, things like that. One of our buildings down in Tennessee, we went to look at it, and I'm looking at all these blue tubes, Pillsbury, all that pop and fresh dough. They're storing the empty tubes in the building.
That's crazy.
And
Yeah.
the tubes are even there before they're blue. I'm looking, you can see the various stages when they're first just the lined cardboard before they put the blue wrapper on, telling you what's being in there. So automotive, all the cars that are built here, some of those parts are stamped here. They're all distributed here. So even if they're made overseas, they're going into warehouses, they're being sorted, they're being distributed at the smaller amounts and then shipped to whether it's a car dealership or repair shop, or even some of our properties are close to the manufacturing plants where the suppliers have to be within so many miles of the factory.
Now, I know that you're going to use a lot of numbers in answering this question.
Well, as long as I can count it on my fingers, but
so
okay.
Just help me out. And
Sure.
For those that don't know the East Coast or the Eastern Seaboard or that whole, the North, South, and the East and West, what are the criteria that you use to identify opportunities to acquire industrial? How do you find deals to invest in?
Well, ideally we look for properties that are in proximity to the major north, south, east, west roadways, or close to rail lines or close to ports. So if you think about it, like if you're in the Northeast, 95 goes from Maine to Florida. So you got, 65, 75, 85, 95, whether you're going from Michigan down through Louisiana, or whether you're going from Michigan down to Texas, or whether you're going east to west, like Route 80 starts in New Jersey on the coast and goes all the way out to California, things like that. And then there are certain cities that we call wheel and spoke. They have a circle around them and then a bisecting set of highways that go north, south, east, and west. Something like, Atlanta, Indianapolis, Columbus, Ohio, Cincinnati, Ohio, or else the juncture of two major roadways, and form an X. And then there are other smaller assets we call, flex assets, which probably have a lower ceiling height and potentially smaller tenants using them. And those also have proximity to the major roadways, but they'll be a little further off the roadways. But then there are tenants that need to be there because their clients are there, or their customers are close by, or they serve a certain community. And sometimes there are barriers to entry where there is no more land for development. So we look at all these factors.
The other thing I know that it's very important to you is the employment base, isn't it? You see a tenant that's got hundreds of employees in a location. Talk to me about how you start to kind of feel your way into whether a deal is a good deal or not.
Sure. I guess about 7 years ago, we started looking a little more at the business operations of the tenants themselves
Mm.
In addition to, think about you buying a building, you want to know what are the rent comparables, what are the sales comparables. But here it's not just that, it's how many people work in a particular business. Like we bought one property in Indiana, closed in June. They employ 500 people. They're open 24 hours a day. That employer cannot move more than a mile or two without disrupting his workforce. Because people are not necessarily going to commute an additional 30 minutes if they can get a job down the road for an extra dollar an hour at somebody else's distribution facility. So that's why some of these tenants are very sticky. In our properties down in Chesapeake and Norfolk, Virginia, you're sort of landlocked. You can't build on the peninsula because of the water table, and you can't move off the peninsula because your tenants aren't going to your employees aren't going to sit in traffic through tunnels and bridges to commute for the same salary. Uh, so that's also a significant factor in the decision-making process. How readily available is your workforce? How long has your workforce been with you? How much do you value your workforce?
Right. And then you have some properties that are really close to major airports as well, don't you? Right. In the sense,
Yeah.
talk
Now, we
about.
do have some that are close to major airports. It depends where supplies are coming in.
Mm.
Sometimes they come by rail, sometimes they come by boat, sometimes they come through the air. Um, so we look at things that are in proximity to all major forms of transportation.
Um, Scale. So the size, I know I've seen pictures of some of them. They are just these mega scale warehouses. So what are the kind of the range of size in terms of square footage of the assets that you both have in the portfolio, but also that is kind of your sweet spot when you're out there looking?
No, we look at everything that's probably 150,000 square feet and up. But then again, it's the same amount of effort for a $7 million acquisition as it is for a $70 million acquisition. So you look at what's really the best use of your time and the best long-term fit for the portfolio and for your investors. We're finding that there's a lot of opportunity on the smaller side assets where you can get some additional going in yield. And in that case, we look for assets that fit into the existing management footprint because we can easily manage them while picking up some significant yield for the investors. In a new market, we'd probably be looking at 300 or 400,000 square feet, multi-tenanted, to put a new flag in another state.
Um, can you tell me who are some of your tenants? I think that also helps to
Sure.
put a sense.
Some of our tenants, we have General Dynamics, who does work for the Navy and the Coast Guard. First Data, you lose your credit card in the middle of the night, you call American Express or MasterCard or Visa, they call First Data. First Data opens the vault, they print out the steel cards, the plastic cards, they put the microchips in them, and they FedEx them out. They're open 24 hours a day. Uh, we have John Hopkins University Medical Center. We have the state of Maryland. We have the state of Ohio in our Ohio
They have
property.
Amazon as well in one of them.
Yes, we have Amazon as well. We have SCIFs, which are secured communication intelligence facilities, government contractors. Uh, Pillsbury, environmental cleanup guys, jobbers for Toyota, Subaru, and Nissan, as well as Honda. In some of our factories, we have one of our buildings that we manage in Ohio. They make the buildings for Buffalo Trace. They make the bottles, excuse me, for Buffalo Trace bourbon. Uh, so
Right.
they blow the bottles and they truck them across the state line to Kentucky.
Yeah.
So
So it's a lot of household names in some cases.
yeah, yeah. I don't, some of the names I have, like I have tenant merge. Like we've all gone to the airport and we've seen those vending machines with the glass bottles of the fresh food in them.
Yeah.
That's in one of our properties also. We have coffee roasters, ice cream
You name it.
manufacturers.
Phenomenal. It's really interesting. So, what is the general investment thesis? And let me just hint. I know that number one is don't lose money, but then you also look at cash flow, and so what is your general? What would you describe Heritage's general investment thesis as being?
We we're investing for cash flow. So we're looking for deals that could pay at a minimum 7% the first year, or if they can't pay 7% distributable, and there's a reason why, like there's a lease up or there's a free rent period that has to burn off, or some other issue that we could sort of explain to ourselves before we explain to anybody else, then we'll look at it. There's sometimes like we're looking at a 850,000 square foot portfolio on Monday where we'll meet with the seller, and we've tried to buy it. Somebody offered $5 million more, so they went to another buyer who since dropped the contract. And we noticed that while they were interviewing us and we had questions for them, the current generation of ownership couldn't answer them completely. So we look for opportunities with management upside also, where there are a lot of inefficiencies. But again, it's all focused on how do we get to double-digit cash flow? Is it sustainable? How do you manage the tenancy? How do you keep the property full? And again, also how you manage capital markets event with as far as placing the right term debt for the right term hold.
All right. So what is your philosophy about debt? Because that's been the killer, hasn't it, over the last 2 years?
Yes. Our philosophy is better to go longer than shorter. And, we tried to put a deal on somebody else's platform to syndicate. And they said, well, you're at the 5-year, hold on your model. Why are you taking 10-year debt? And I was like, well, it's 3.25%, 10 years interest only. Why wouldn't you take 10-year money? It's like free money. And, now they're chasing us to put stuff on their platform. But our investor partners are very happy with that, look. So we're going to take the longest term debt that we think makes sense. In some cases, it's 5 years. Well, most of the time, it's 7 or 10. In the few occasions that we have done floating rate debt, we buy a full term interest rate cap. Although now, from listening to Jerome Powell's last speech, rates cuts are coming this year. That was, I think, his last message to Congress, probably later in the year. So I don't think floating rate's going to be as much of an issue, although there's very little difference between floating and fixed today. But I would probably take floating rate, and the cap is probably going to be on a more reasonable basis. But then again, we don't typically borrow more than 60 or 65%. I like to know that if I lose, 20% of my tenants, I can still pay the mortgage. I don't want to have to put out a capital call notice.
Right. And then, what kind of, so I know that the company has just recently started to look for outside investors, accredited investors.
Sure.
You're looking beyond the friends and family that has sustained the company for the last 3 generations. But why don't you answer this question? Who are you not for? Rather than who should hang up now on this podcast and not pay any more attention?
Anybody that's still chasing IRR, that thinks, that wants the riskiest investments, that they don't care about current cash flow. I think enough of them learned their lesson, where now they realize that, total return is not the way to go. But if that's still your risk tolerance, then, you're going to be very disappointed, because we're just going to pay you quarterly, and there will be a pop at the end, but it's not going to be a grand slam because you're getting it along the way. So anybody that's used to extremes may not be the right investor for us. But anybody else who's really looking to have continual distributions that they can buy themselves nice things with, or God forbid they're unemployed for a period of time, help pay their bills and really create their wealth on the back end when the property is sold. Those are the people we want. We want, the right people with the right mindset and dedication to their financial goals.
And your role over there, I know, is investor relations, but it's also acquisitions. So what are the biggest challenges, Irwin, that you're seeing in the market today as far as acquisitions and opportunities?
I'm seeing a lot of opportunities. I just wish I had, $500 million of cash. In a perfect world, if with enough of these smaller, 9 cap unlevered deals, if I could buy them, I would wait 2 years for interest rates to drop. The institutions are all waiting for extreme distress and saving their dry powder for distress. You have some institutions, because they operate funds, are still looking for high IRR deals and are willing to tolerate very little cash flow. And I think eventually their investors will give them a problem.
Right. That's let's just talk about that briefly. So, but that's because what they're looking at is they're projecting out to a big exit. That's how they're getting the IRRs, right?
Correct. They get the funds make their money based on 2 ways. It's on figure it's 2 and 20, 2% on assets under management, and then 20% promote over whatever the preferred hurdle is in the fund. And so for them, they need a big IRR. So the fund doesn't necessarily need to distribute cash flow to their investors. So they're willing to take more risk for more reward
On the exit
on the
and
exit.
less
Correct.
right. And that's never been your approach.
No, it's never been our approach. I like getting those distributions personally.
Mm.
Every once in a while I see an extra, $7 or $8 or $10,000 that hits the checking account. I'm like, oh wow, I forgot about that. So it's a pleasant surprise. And then of course, in the few instances we've done, refinances and there's been cash out. Of course, that I know is coming, but it's nice rainy day money to have. I could take it to whether I bought my daughter a car. You could take it and accumulate it and reinvest it in another property and compound it yourself.
Mm.
So there's a lot of options to do with that.
And the challenges, did I ask you that already, or the opportunity?
Yeah, no, the
Challenges
challenge
come
are
from.
is finding the right deal with the right scenario, and without a refinance or financing risk or tenants that can move. So we spend a lot of time there, and then we're also finding a lot of deals that really need some seasoning. And so I'm of the don't ask, don't you don't ask, you don't get. And I've asked sellers to stay in for a piece of the equity because I don't want to, go out and raise a lot of equity for it, and they're actually open to entertaining that. I have one seller that it's a partial leaseback. And I told them why it's not financeable. So now they're chasing me to have a discussion about seller financing on the deal. So it's just about the right creativity and the right structure.
Mm.
And again, the right risk reward for us. But then, we're very risk adverse.
What is the characteristics? How would you describe the characteristics of the sellers in industrial, the kind of deals that you look at? Are they families like you? Are they institutions or are they business owners? What are
Some are business owners, some are institutions, which unfortunately for them need a certain price before they'll transact. So sometimes, even though you make an offer, you could be the high offer because it doesn't fit their return model for IRR on their total exit. They're not willing to sell and they'll hold it. And then sometimes they come back to you when they see the market going back the other way and they run at you. But we're also seeing a lot of medium-sized owners that have decided, you know what? Yeah, I should have sold 2.5, 3 years ago. I'm still making money. I don't know what's going on, or I'm too old for this and I'm going a different direction.
how vulnerable is industrial real estate to the overall economy? If the economy goes into a recession, does that spell bad news for industrial?
It spells bad news for industrial that's in the development pipeline, which is not leased. And if you look at some markets, like I think Phoenix, I read, 25% of their total stock is also in construction. So there's going to be a 25% availability. And that means those rents aren't growing. Those rents are going backwards. That means there's going to be an increase in vacancy on some of those properties. In Dallas, at one point, there was so many buildings that were built on a speculative basis. When we bought our asset in Murfreesboro, Tennessee, just driving out from Nashville, Prologis had built a lot of these monstrous boxes on a speculative basis, and all right, they're publicly traded. It's cheap capital, and then eventually they figured they lease them up. Uh, but we're not competing with those. We're not, we're very sensitive to things like replacement cost. So if I'm buying a building that's costing me $50 or $70 a square foot, and it's fully occupied, and I know to build a brand new building without land is 140 to 150, I feel pretty good that I can keep it full. If the economy really takes a step back, I may not be able to continually increase rents, but I should be able to keep it full and pay the mortgage, which is more important.
Yeah, exactly. So what are the biggest mistakes that you see industrial investors making? Or even what are the mistakes you've made? I know you guys are straightforward about it. Thing
No,
like
we
lessons
did.
you've learned kind of thing.
Well, we shy away from single tenant buildings. We bought a portfolio of 3 buildings out west that were, net leased to KB Toys. I drew a blank. And, first bankruptcy, the private equity shop came in, tried to rescue them, and then with the second bankruptcy, that was it. Uh, it was pretty much all our money, and we worked with the lender. The lender got whole. We got some of our money back, but we, had a good relationship with the lender that we helped them, you know, get all their money back. And since then, they would call us from time to time. Did we want to take a look at a building? Did we want to manage a building for them?
Really?
So that's why we do very few, if any, single tenants, except for the one we closed in back in June. But then with 500 employees, I'm pretty confident that first of all, they're not going out of business. It's a national pet supply distributor that owns 200 stores, and there are 300 franchisees, and you have to buy through the main, through the parent company. So it was like a super highway of forklifts. If you didn't turn your head four
That's
ways, you
right.
got
So,
run over. It was like the
right, right.
Indianapolis 500 with forklifts. It was amazing.
You're talking about walking into the warehouse.
Yeah, yeah.
How big is that thing?
I think that was like 768,000 feet, one building.
Isn't that incredible?
Yeah.
That's what's that, almost 20 acre. How many acres is like 15?
I don't recall, but
Dang.
that's not that incredible because on the things we own in
Hmm.
Liverpool, New York, outside of Syracuse, Amazon built a major distribution facility. It's 90 feet tall. It's like three buildings tall. It's 3 million square feet.
It's just insane.
And of course, they took an old golf course and had it rezoned in order to build it and things like that. There's another story of that, but it's amazing. You see the building like for miles coming up the road. Like, what is that?
And you guys, I mean, when I say you guys, I mean the senior people at Heritage. You visit your properties regularly, don't you? It's not like you just sit back and let other people do it. You guys are there all the time.
No, we are all the time. Frank James, who is a principal in the management side of the business, is physically at every property at least once a month. When there are larger leases that have to be negotiated, on a vacant space, Jeff will get on a plane and go there. Uh, Especially to meet a tenant face to face. It's easier than, brokers and asset managers. Sometimes you get a little bit of more credibility when a principal shows up to meet a prospective tenant. And so, we take our relationships not only with our lenders and our investors, but also with our tenants very seriously.
So why should somebody who, most of the accredited investors, most professionals who have real day jobs, right, unrelated to real estate, who are looking at investing in real estate, it's so intuitive to think about multifamily, right? So we all pay mortgages and we pay bills and everybody lives somewhere. You'd understand it, but there's no intuitive real understanding of industrial warehouses quite the same. Why should a multifamily investor think about industrial? Why as an
Well,
alternative?
sure. If the interesting thing is, I don't think most in multifamily investors really do a deep enough dive. The interesting thing is, especially in the last 15 years, if they ever looked up a specific property and see how many times it's traded in the last 12 or 15 years. And if you sometimes we can find some of the old offering memorandums or syndication books. How many times can you tell me you're going to renovate a kitchen and a bathroom and put new plank flooring in and move the rents? How many times can you do that successfully?
That's an incredibly insightful observation, I think.
And if you look at the portion of salary and wages that someone has to pay for rent, they used to say 30% was the max, but in some locations, if you want to live in certain buildings, you may be paying 50%. How sustainable is it? As somebody moves rents, what kind of turnover are you going to have in a building? When we were in multifamily, if I was able to keep a tenant in place and not have down, retenanting costs, whether it was a leasing commission or a 1 or 2 month vacancy and have to pay someone to lease it and prepare it, that was also a way of getting an increase without having to have a vacancy. And so it's about managing, your tenants. And also when you think about who pays the operating expenses in a multifamily property, okay, the tenant might be paying all their own utilities, but there's salary, there's insurance, there's real estate taxes. And in the last year and a half, in a lot of markets, insurance per unit at least doubled. In some cases, it went up 3 or 4 times if you were close to a body of water. Uh, all the municipalities are trying to recoup some of that COVID money, so real estate taxes have been going up, payroll costs have been going up. There are supply chain issues with making sure you get your supplies for your renovations. And then with everyone pouring all this money into apartments, there aren't really enough qualified contractors out there. So if you're not really seasoned enough, are you effectively negotiating your renovation contracts, and how are you managing those third-party contractors that are doing work for you? Are they taking your deposit and skipping? Are they taking on too many jobs and dragging you out and not completing things on time? What we do, the tenants pay all, most, if not all, of the operating expenses. And we know the property needs to be maintained because the tenant has to be open for business to operate in order to pay us rent. So we have, although there are some issues that are on us to maintain, a lot of the costs, if not all, are borne by the tenant.
Uh, Opportunities. Where do you see opportunities in the coming months, Owen?
Well, I do see a lot of opportunities actually in all asset classes. When you look at the wall of maturities in the next 2 years, 100 over $100 billion. Uh, but I also see a lot of loans that are in trouble. If any investor who's in multifamily deal took the name of their sponsor, put it to the search bar and Google and added troubled loans, loans of default, foreclosures, they'd come up with everybody who's got, this one's got, $500 million on a watch list. This one gave back a property. This one's not talking to investors. It would be quite shocking to see how many deals are on watch list, if not really, pending foreclosure. Lenders are trying to work with them because if a lender has to take back a property, they have to, write down their equity. It hits their balance sheet. So lenders aren't so quick to do things, but eventually these deals will come to market.
You used to be a banker, didn't you, Owen?
Yeah, I was a banker 3 times in my last, 35, 38 years. Sure.
Do you think the banking industry is going to be impacted by commercial real estate this cycle?
It could be.
Mm,
Uh, it might get out with a small haircut if the Fed drops rates really fast.
mm,
But then again, there's always a lag between cap rates or values and interest rates moving up and down. I think cap rates are probably close to their high now. Uh, well, I wish they'd go higher, at least for industrial. But I think if the Fed starts to move rates and cap rates will stabilize. But I think there are more deals that will not be able to get out whole than will.
mm. But
And I think that's not going to affect the lenders. I really think that's going to hit the investors more.
Good. In what way?
That, the deal will sell, but there will be a loss.
Yeah.
If anything, they'll get out whole. There won't be a profit. And if it was a deal where you were basing your investment thesis on an IRR and you didn't get any cash flow along the way, you really lost money,
Yeah.
even if you got out even with your principal.
Mm. Exactly, because banks are negotiating with borrowers just to recover their debt.
That's correct. That is the primary focus. How do we get our loan repaid with all back interest and any capital outlays we made on advancing for taxes or other deferred maintenance? The bank wants to be whole.
Without foreclosing on you, the sponsor.
Correct. And the sponsors want that too, because none of the sponsors want foreclosure on their record with any lender because they'll have a problem borrowing.
Right. Yeah. So the investors are the ones that come out hurt
That's
the
correct.
most, unfortunately. Well, Owen, it's always a pleasure to talk to you. Any other thoughts that you want to share about industrial or any other asset classes that you're interested in looking at? We're here in Q1 of 2024. As we move towards the end of the year, are you just focused on industrial or looking at other asset classes?
We are looking at other asset classes. We've looked at the beginnings of some distressed multifamily, but it still doesn't make sense because a lot of these loans, you have to assume the debt. They can't be refinanced. And if you have to bring $1.5 million to the table just to buy a longer term interest rate cap, you're really behind the 8 ball before you bring money in for anything else at the property. So I think it's like, as some of these owners are saying, stay alive till 25, to try to figure that
I think
out.
that's realistic.
I think if they can stay alive till 25, when interest rates have come down, hopefully 100+ basis points and values sort of come in, and since inflation is really starting to get tamed and they can control their operating costs, I think they'll have a better chance at a better exit where maybe the investors don't get totally wiped out. Maybe they can get out whole. But there's some properties that are still performing really well. It's not all sponsors, all properties.
You also
It's
said that you've been seeing some smaller industrial with nine caps.
yeah, a lot of them.
Really? So
Yeah.
what kind of scale and why is that not something you are vacuuming up?
As I said, we are trying to vacuum these all up. And if a perfect world, if I had $500 million, I would just buy them all.
Mm,
A lot of our existing investors look for larger properties. They write larger checks. And
right.
so this is the first year we will actually look more towards the, accredited high net worth investor who writes smaller checks, who likes to be in multiple deals, and wants an alternative to multifamily. I was at a conference a couple days ago, and I met with a lot of these people who have been in many deals and are very disappointed on, they know the IRR isn't coming and they didn't get any cash flow, and some of them have stopped distributing, and some of them the investor relations communications is less than desirable, they believe less than transparent. And some of them are prepared, well, unfortunately, they've said to me, look, I think this investment is gone and that investment is gone. And one doctor who I have as an investor who writes very large checks, he had invested in too many office buildings, and 7 out of 12 had to go back to the bank. So I think that until the economy really turns around and the interest rate environment turns around, that people should be more focused on an investment's ability to pay current cash flow than they should be about being attracted to, any projected IRR.
Well, as that is where we opened, let's close there. Irwin Boris, who is in charge of investor relations and acquisitions at Heritage Capital Group, thank you for joining me on the podcast today.
No, my pleasure, Adam. I look forward to doing it again. This was great. Very informative. I hope investors hopefully got a little knowledge. If they have any questions, feel free to go to the Heritage website. There's a lot of white papers and educational data there, in addition to other recorded film that they can watch on our outlook on the market and how we do work.
And I'll include links on the podcast page to that as well. That's where you'll be able to find it. Again, thanks so much, Irwin.
Thank you.
All right, that was Irwin Boris of the Heritage Capital Group. Irwin, it's always a pleasure to see you. I really enjoy our conversations, and thanks so much for joining me today. It was a lot of fun. If you want to know more about Irwin, go to the podcast page at gowercrowd.com. And as I said at the beginning, be sure to subscribe to our newsletter. I will announce this podcast in there and upcoming podcasts. And we have educational content and news updates, all kinds of good stuff. You can always unsubscribe, all there at gowercrowd.com. And thank you for joining me today, everybody. It's always a pleasure to be here. Doing these podcasts and these YouTube shows is one of the favorite things for me. So I really hope you had a good time and you enjoyed it as well, learned something from Irwin. But that's it for this week. So until next time, this is Adam Gower signing off.